Good morning. Welcome to Good to Know Talk series, where our focus here is to provide financial strategies and tax tips to help grow your business and save on taxes. We understand that business owners are on the move and you need to know how information applies to your personal business. I'm your host, Janean Kong, and owner of Smart Tax and Business Solutions. I am a certified tax strategist and enrolled agent. I help you pay less tax through proactive tax planning. This morning, as always, we have James Ka on the line. James is a financial advisor at Edward Jones. He's my trusted source for information in the industry, and he's here to answer questions and offer his expertise. James, good morning.
Good morning. Can you hear me?
Yep, we can hear you.
Okay, good. Yeah, how's everything?
Good. It's getting pretty busy here at my office with tax season officially here.
Yeah, in full swing.
Yes, but it's a good busy. So yeah, I can't complain.
Good. No, I'm excited to, in the next 4 or 5 different series, to dive into real estate. I think that's, an opportunity, an area that a lot of, business owners look into to kind of diversify their portfolio. So yeah, I'm excited to hear more. And then if there's any investment related questions, like you mentioned, I'm always here to help.
Okay. Yeah, thanks. We actually, today we begin our 5-week series on real estate. And, I'm excited to talk story with experts in the field. And with us today, we have Tara Foddy, who is a Maui-based realtor with Keller Williams Island Living. And I've asked her to give us a brief introduction to real estate in general. Tara, are you on the call?
I am. Good morning. Can you hear me?
Hi. Good morning. Yes, can hear you. Thanks for being with us.
Absolutely. Thanks for having me. I appreciate it.
Yeah. So you have some general tips for us in real estate that you can offer our listeners?
Absolutely. First of all, my name is Tara Foddy. I'm very appreciative to have this opportunity to speak with you all and work with Janean, James, and their trusted industry peers on this topic specifically, that is real estate. I wanted to share a little insight before the 5-week kickoff for Janean's topic, just to give your audience some thought processes to put in place when considering when and how to invest and or purchase initially, and thought that this would be a good introduction to the real estate series that you're about to share over the next 5 weeks. So a little bit about me. I am from Oahu, but currently reside on Maui. I became an agent with KW Island Living, who's Keller Williams, on the island of Maui. We are one of the largest, if not the largest, brokerages across the island, and I'm loving this industry and what it has in store for future from from an investment standpoint and long-term financial security lens. So I work with local vendors, meaning I try to lean on any local lenders, local financial advisors, local tax planners like yourself, because I think it's important that we work with people who understand not just our locale and where we are from a demographics perspective, but also to understand the difference that is Hawaii. And we all know that we are very unique in that we operate professionally equally as we operate personally. My specialties include negotiations, high level contracting, and high level client touch. So we can just spin off into some steps that I wanted to share with you when considering purchase or investment. And so we can go on to the next slide. Thanks, Janean.
Mm-hmm. Sure.
Before you buy, invest, identify your investment goals. I think oftentimes when we look at purchasing, we don't go through the full activity or exercise to understand what is it that we want out of this property? What do we want 5 years from now, 10 years from now? Is it something we're going to keep in our family? Is it something that we're going to spin off for a short-term investment? Is it something that we're going to just have on the side for a nest egg? So just really doing that type of thought process activities to ensure that while you're going through the very, very tedious process that is real estate purchasing, the contract period and window can be very taxing. So understanding what your goals are before you commit to the process is important to keep you on track and to keep you motivated through the process that can be emotionally taxing, but ultimately very beneficial. So just understanding that and leaning on your whys throughout the process would be healthy. Also, before you sell, another part of investing is what you do with your proceeds from a sale or successful sale or purchase. How much money do you want out of the sale? What do you plan on doing with that? Reinvesting and or putting money aside. There's a lot of different real estate strategies that you'll learn down through the series as Janine rolls it out, but there's going to have some talk about 1031 exchanges and other real estate investment opportunities that do exist outside of the normal purchase process. Life demands and change, things happen from the time you purchase something versus when you roll up to selling it or flipping it, because you might buy a property when you're single and then you grow into a family. You might buy a property when you have a family and you're exiting when you're single. I mean, life changes, and so just understanding that process of what you're going to do, on your exit strategy at the end of whatever your result is. Time is of the essence. I just talked about the contracting process. It can be very taxing. Everything is pretty, I wouldn't say compact, but it's a very tight timeline. So understanding what we want out of it will assist us getting through emotionally. And back to, again, what do you plan on doing with your proceeds? So just a couple of things to consider before you purchase, before you buy, invest, and or sell, just to get us through a healthy thought process and window of what is a contract with process. And we can go to the next slide. Items to collect for your lender. This obviously will vary depending on what type of purchase you're making, what type of loan you're trying to acquire. And that also leads back to your goal ultimately of what you're investing in from a real estate perspective. So generally, lenders like to see, and of course, you'll have a lender who's a specialist in that specific field come on later down in the series, and I'm just being a source to the source. So generally, you'd want to have your 2 most recent tax returns so that they can track that financial, where the income is coming from, et cetera, and all the pertinent information they need to pull from that in order to assist you with the qualification process. 3 months of bank statements. They want to see some steady income and that the money pretty much is staying there and it's not, in and out in a certain period of time. They want to see some consistency in funds that exist. Of course, your completed loan application that will be with whoever you choose to try to get lending from, and the type of loan you're trying to acquire. And tips on leveraging your position throughout the process. I think it's important for us to understand what we can do as individuals, whether we're looking at commercial investment and or personal investment, residential. Understanding your buying power, it's very important that we know what we're working with from a buyer's perspective. That's how negotiations can come into play and benefit you as a buyer, investor, is to understand exactly how much money you have, how much access you have to those funds, so that you can really leverage your position during the negotiation process. Understanding your walkaway points. So often in negotiations, especially with properties, whether it is personal or professional, it still holds a very emotional point in our hearts. And and in our mindset, because we have emotional or personal attachment to it. So understanding your walkaway point in any type of negotiation you enter, especially when it comes to property or real estate, is to really feel comfortable with your end result. So it's understanding whether you want to keep negotiating on a certain point, whether it's price. We all know that returns can be tangible and intangible. That is dependent on what your goals are. That all aligns back to what you want to get out of this transaction. And so know your walkaway point, understand your buying power, which means your financial status, and then staying organized and reading your contracts, understanding what you're signing, and really having a partner in that as an agent or realtor, whether, again, it's commercial or residential, that is hand-holding you through that, making sure you're comfortable with every step and that you understand what you're committing to. So those are just some points I wanted to share with you, and I'm grateful for Janean to allowing me the opportunity just to get you in the right mindset from a purchase or investment perspective, the types of information documentation you might want to start collecting, and leveraging your position throughout the process. Thank you for the opportunity. Please let me know if you have any questions.
Thanks, Tara. Yeah, I think the big takeaway really is planning ahead, and when we talk about real estate investing, I often see several just tax mistakes, and I'll get into that a little more. But yeah, thank you for sharing with us your expertise.
You're welcome. Thank you. Absolutely. I'll piggyback on that. You're absolutely right. Planning with the right team, planning with the right industry experts is essential in being comfortable and ahead throughout the process.
Mm-hmm. Yeah, and that's actually the biggest mistake that most people make when it comes to taxes, really is failing to plan. And I have a quote on the screen right now, and I love this quote, and it's worth repeating over and over again. It was given by Supreme Court Chief Justice William Rehnquist, and it says, "There is nothing wrong with a strategy to avoid the payment of taxes. The Internal Revenue Code doesn't prevent that." And, why tax planning? Tax planning means looking forward to minimize your taxes, not just recording history. What should you do? When should you do it? How should you do it? And, tax planning gives you two more powerful advantages. First, it's the key to your financial defense. You have two ways to put cash in your pocket. Financial offense is making more, but financial defense is spending less. So for many of us, taxes are our biggest expense. So it makes sense to focus our financial defense where we spend the most. And second, tax planning guarantees results. You can spend all sorts of time, effort, and money promoting your business or working on your portfolio, but that can't guarantee results. Or you can set up for example, medical expense reimbursement plan, deduct your daughter's braces, and guarantee savings. And the bottom line really is you lose every time you spend after-tax dollars that could have been pre-tax dollars. So I'll say that again. You lose every time you spend after-tax dollars that could have been pre-tax dollars. So in the end, and I've mentioned this before, there really are four main buckets of strategies you can use to cut your tax bill. We have timing-based strategies, like using a 401k deferral to shift today's tax bill to tomorrow. We have income shifting strategies to move taxable income to lower bracket taxpayers like your children. We have code-based strategies like Section 105B that will let you deduct your family's medical bills as the business expense. And lastly, we have product-based strategies like separate managed accounts and insurance. The second mistake I see when it comes specifically to real estate is missing depreciation. when it comes to filing taxes on your rental properties, you'll start with your total rental income, then you'll subtract your obvious operating expenses, like advertising, insurance, interest, maintenance and repairs, professional fees, etc. But then you get to take depreciation deductions. And depreciation is the process of writing off a capital asset, such as a rental property, over a period of time intended to approximate its useful life. So for residential properties, this is 27.5 years. For non-residential properties, it's 39 years. Depreciation is especially valuable because it's not an actual out-of-pocket expense. But lots of investors miss valuable depreciation deductions because they don't know how to make the most of them. Now, raw land is non-depreciable, but what about land improvements? Driveways and sidewalks, they crack, landscaping needs replacing, and pipes from the house to the street deteriorate over time. So you can depreciate land improvements over 15 years. If you miss those assets, you lose money. You can also break out personal property included in your property and depreciate it separately. So this process is called cost segregation, and it lets you depreciate that personal property over as little as 5 years, which gives you far more deductions in the early years you own your property. Let's see. Let me switch to this next. So personal property includes all sorts of assets you can break out to boost depreciation deductions. I have a list on the screen. This includes, cabinets, your appliances, your security system, the different power supplies, your refrigerators, your window treatments. And the best part is if you've missed out on these deductions in the past, you can still take them. And this process is called a cost segregation study. And it lets you go as far back as 1987. It will calculate what you could have depreciated versus what you actually depreciated. Then it takes the difference as a deduction in the current year. You won't have to amend your old returns. There's a form 3115, that you can file with the IRS. So please see me if you have real estate and you haven't done this. One of the most important decisions you'll make as you own your properties involves distinguishing between repairs and improvements. Repairs are deductible immediately as you make them. Improvements are depreciable over time. It usually makes sense to characterize fix-ups as repairs so you can deduct them faster. The definition seems straightforward enough. Repairs keep your property in good operating condition. They don't add value and they don't prolong the property's use. IRS examples include painting, plastering, repairing broken windows, fixing gutters, floors, leaks. Improvements, on the other hand, adapt your property to new uses. It adds value or it prolongs its use. So some examples include room additions, upgrading appliances, new landscaping, and replacing, things like roofs and windows. But, even the Internal Revenue Manual that tells IRS agents how to audit you admits that distinguishing repairs from improvements is a little bit of a gray area. You would think that replacing a roof is pretty clearly an improvement, right? Common sense tells you it adds value and prolongs the property's life. But there was actually a recent tax court case that ruled that an investor could deduct a roof as a repair because it just helped keep the property in good operating condition. So a little bit of a gray area. And I want to mention the Tax Cuts and Jobs Act makes 2 changes to depreciation rules that apply specifically to real estate investors. One, it expands the definition of qualified real property eligible for Section 179 expensing. So it now includes roofs, heating, ventilation, and air conditioning. It also includes security systems. And second, it bumps the amount of first-year depreciation that you can claim up. Let's see. It bumped it up for $10,000 for the first year, $16,000 for the second year, and then $9,600 for the third year. So that was a recent change in the new tax law. I also want to mention a fourth mistake, which is investors versus dealers. And most investors buy property for long-term investment. Your total return includes current income from rents and long-term capital appreciation. But some investors don't want to manage tenants or hold long-term. They'd rather buy, maybe rehab, and flip for a quick gain. But how does that affect your tax bill? If you buy a property to hold and manage for long-term gain, it's considered an investment. There's no self-employment tax on rental income or gains. You can take depreciation. When you sell, you can take advantage of lower rates for long-term capital gains. You can even use tax-free exchanges to defer tax on your sale. But if you buy a property with the intent to resell it in the ordinary course of your business, it's not considered an investment. It's considered a dealer property. It's essentially treated like inventory, just as if you were selling groceries or car parts. You'll owe self-employment tax on your earnings. You can't take depreciation deductions. Your profit when you sell is treated as ordinary income, and you can't use tax-free exchanges to defer tax on your sales. And one thing to consider, for most dealer properties, if you are looking to go down this route, the biggest problem really is the self-employment tax. So if you want to reduce that tax, you might consider operating that part of your business as a different entity, like as an S corp, for example. The last mistake I want to mention is missing family employment. Hiring your children and grandchildren can be a great way to cut taxes on your income by shifting it to someone who pays less. Yes, there's a minimum age for now, at least. They have to be at least 7 years old. I've seen recommendations that you can hire your younger children to serve as models for your advertising, but I'm not aware that particular strategy has been blessed by the IRS yet. So for your kids, their first $12,000 of earned income is taxed at zero. That's because it's the standard deduction for a single taxpayer, even if you claim them as your dependent. The next $9,525 is taxed at just 10%. So you can shift a lot of income downstream. You do have to pay them a reasonable wage for the service they perform. And the tax court says a reasonable wage is what you would pay a commercial vendor for the same service, with an adjustment made for the child's age and experience. So if your 12-year-old son cuts grass for your rental properties, pay him what a landscaping service might charge. If your 15-year-old helps keep your books, pay him a bit less than a bookkeeping service. Does anyone have a teenager who helps with your website? What would you pay a commercial designer for that service? To audit-proof your return, write out a job description and keep a timesheet. Pay by check so you can document the payment. You do have to deposit the check into an account in the child's name, but it doesn't have to be his video game fund. It can be a Roth IRA that you set up with James. For decades of tax-free growth. It can be a Section 529 college savings plan, or it can be a custodial account. I've given this example before, but this is such a powerful strategy that I'll mention it again. So let's say your teenage daughter wants to spend 2 weeks at soccer camp. You can earn the fee yourself, pay tax on it, and pay for camp with after-tax dollars. Or you can pay her to work in your rental business, deposit the check in her custodial account, and then as custodian, write a check to the camp. So hiring your daughter basically lets you deduct her camp as a business expense through your rental properties. If you hire your child to work in an unincorporated business, so in a sole proprietorship, or a single member LLC, you don't have to withhold for Social Security until they turn 18. So this really is tax-free money. You will have to issue them a W-2 at the end of the year, but this is painless compared to the tax you'll waste if you don't take advantage of this strategy. So, as in the weeks to come, we'll be, looking at the lending, legal, and some of the more complex sides of real estate, including 1031 exchanges. I just wanted to mention that there are several tax strategies that are very powerful. And if you have any questions about what we talked about today, please don't hesitate to reach out to us. info@smarttaxhawaii.com. I'm sorry, I'm just seeing some questions here. I have a question. If someone is flipping homes as business, do they have to pay GET for the house income as gross or net or at all? Yes, they do have to pay. That's a good question. So if they don't have rental income because they're just flipping it, then there won't be any rental income, but they will have to pay, they will have to pay GET when they sell it because it's treated as inventory. So yeah, that's a great question. You do have to pay GET when you sell the house. That's a great question. Is there any other questions?
I think Tasha had a question, and she asked if there are better lenders than others.
Oh.
So maybe Tara, you want to chime in on that?
Can you hear me?
We can hear you.
We can hear you.
Oh, okay. You can hear me now?
Mm-hmm.
Are there better lenders? Some lenders are specific, purchase specific. For instance, there's some lenders that only do, I know only one lender on Maui that does land loans, for instance, which is a different type of lending versus just buying a property for your single family home versus a property with single family plus attached to detached cottage. So the short answer is no, there's not better lenders. I think it becomes more of a preference when it comes to accessibility to your lenders. For instance, I prefer to work with local lenders who I can sort of walk in their office and tap on the shoulder if I need to poke them on my client's behalf. So there's not better lenders, but there are, of course, experience, personality, all of those things come into play, the natural side of it. But as far as selection, I think it just comes down to preference and the type of purchase you're making. What are your thoughts on that, James?
Yep, I unmuted. Yeah, I think it's whatever, I like to sit down when I'm referring my clients to a loan officer, primarily to a broker, so they can find the best product for the client. So, with some, if you're working with some, a lender that only has proprietary loans available, then you're going to leave with their type of loan, But if they can reach out to whether it's Bank of Hawaii, First Hawaiian Bank, American Savings Bank, and really broker out and find what's in the best interest of the client, that's what I feel more comfortable with. So it really depends on, you know, having that flexibility and really having that expert look into what's going to be the best customized strategy based on, you know, what you're looking to buy. So that's just my take on things, is that if you sit down with a mortgage broker, they'll have more flexibility to look at different loan providers.
Absolutely. And I don't think that, you know, from a realtor perspective, we are a source and a resource for our industry partners that we work with. So I don't necessarily, I always provide a range and different lender types and different lenders, and allow my clients to really select what works best with them after we look at all of the options that's available to them together.
Yeah, I agree.
Well, we're at the end of our time today. Thank you again to Tara and James for being on the call. Again, if you would like any more information, or you want to reach out to Tara or James, please feel free to email us at info@smarttaxhawaii.com, and we'll get you connected. We'll see all of you again next week, same time, same place. Thank you.
Mahalo so much. Have a good
Thanks.